Looking for a way to lower your tax bill on your investments? Tax loss harvesting can be a good way to do that, but you have to do it right. So what is tax loss harvesting? Well, whenever you sell an investment for a profit, the IRS considers that income or capital gains, and you're going to owe some tax on that profit. The good news is that the opposite is true also. If you sell an investment for a loss, the IRS allows you to use that as a kind of deduction. You can use that loss to offset capital gains you've taken in the past. If you don't have enough capital gains right now, you can carry those losses over into the future. You can even use up to $3,000 worth of the loss against your ordinary income. Now you're probably thinking, well, tax write-offs are nice, but I don't like losing money. Of course. There's two things to remember. First is that every investor loses money from time to time. So you're not going to win them all. You may as well get some kind of benefit from your losses. The second part is that tax loss harvesting doesn't necessarily mean you're giving up on your investment. In fact, if you do it right, you can realize tax losses during market volatility and still get all the benefits when stocks rebound. Individual stocks, this gets a little bit tricky. And that's because of something called the wash sale rule. The IRS doesn't allow you to buy back the same security within 30 days of your sale. Otherwise, the loss is negated. So say you buy a JP Morgan stock one day and stock declines and you want to sell it for a tax loss. Well, that's fine, but then you can't buy back JP Morgan stock for 31 days and still get to count that loss. This creates a problem because what happens if JP Morgan stock rebounds during those 30 days? It's actually pretty common for stocks to get most of their gains for a whole year over only a few days. So being uninvested for even a short period does create some significant risks. There's a few things you can do. You can sell the JP Morgan stock and buy a similar company, let's say Bank of America. Then you flip back to JP Morgan after 31 days. Problem there is what happens if Bank of America stock rebounds over those 30-day period, then selling the Bank of America stock will realize a tax gain, and then you kind of wasted your time doing the whole tax loss harvest trade in the first place. Another common strategy is something called doubling up, and that's where you start out by buying more JP Morgan stock, enough to double your position, and then you wait 30 days, and after that you sell your original holdings, which presumably are still at a loss. This has some obvious risks. If the stock goes up, you do double your money, but if it keeps going down, you have twice as much stock, and so you suffer twice as much. So kind of no matter how you slice it, tax loss harvesting with individual stocks is tricky, and so make sure you're careful with whatever strategy you pick. With ETFs, it's a lot easier, but there's still some pitfalls. So with ETFs, you can always find a very similar ETF to the one you own. So if you have a small cap value ETF for a tax loss, you can always buy some other small cap value ETF. You're not really changing your portfolio exposure very much. You're just realizing that tax loss. But here's pitfall number one. The IRS says you can't buy a security that is substantially identical to the one that you bought within 30 days. Now, what does substantially identical mean? Well, the funny thing is, no one knows, okay? The IRS has never formally ruled on a definition for substantially identical. And so we don't know, is two ETFs that follow the same index, like two S&P 500 funds, are they substantially identical? The IRS has never ruled. So among professional advisors, best practice is considered to use an ETF that follows a different index. So if you're selling an S&P 500 ETF for a tax loss, here at Facet, we would buy a Russell 1000 ETF, for instance, which is another index that follows large US companies, but isn't exactly the S&P 500. Therefore, we kind of think you're less likely to get deemed substantially identical by making that switch. Now, this gets us to the second pitfall. When the market drops significantly, it's quite common for it to also rebound quickly. So maybe at the end of the 31-day wait period, the ETF you bought as a replacement for your original ETF, the one that you used to realize that tax loss, that one might be at a significant gain. We kind of talked about this when we were talking about what would happen with that Bank of America stock if it rebounded. Well, if you sell the new ETF, realize a tax gain, then you've kind of wasted your time with this whole exercise. You should have just held and done nothing. And so rather, you've got to be prepared that if in fact the market rebounds quickly, that you're going to hang on to the new fund you bought. So once again, here at Facet, we're very thoughtful about making the substitutes we use for tax loss harvesting ETFs that we're comfortable holding for the long term. So if you do get that market rebound, you're fine with holding that ETF basically indefinitely. This gets to one of my criticisms about how robo-advisors do tax loss harvesting. A lot of times they'll be hyper aggressive. They'll do it with only very small market declines. And because they do it in such rapid fire fashion, you can wind up holding several ETFs for the same exposure, like 4, 5, 6 large cap ETFs or 4, 5, 6 small cap ETFs or what have you. Here's the reality. How good is that sixth best idea you have, So in my opinion, at a certain point, you're no longer substituting a very similar market exposure. You're actually changing your market exposure. Either that fund's more expensive, or that fund doesn't quite track the right index, or something that makes it just a little bit different. And you don't want to let taxes drive your portfolio decisions. You want to focus on building a great portfolio first, and then letting it be highly tax efficient second. And so if you're going with your fifth, sixth best idea, I kind of question whether you're letting that tax tail wag the portfolio quality dog. And so look, tax loss harvesting is something I call part of tending the garden, right? In other words, it's one of those little things that you should be doing to maximize the overall benefit of your investments. But you have to do it right. Otherwise, you could mess up your portfolio's allocation or just waste your time and not actually get any tax benefits out of it. But hey, what do you think? Do you have a different strategy for pursuing tax loss harvesting? Do you have bad experience about tax loss harvesting? Want to vent? Put a comment in the comment section. I'm happy to respond to anything I see there. And if you like this content, want to see more of our thoughts on how to invest or markets or anything else that's going on in the world, hit that subscribe button. We're going to be coming to you maybe about once a week over the course of 2025 with more content like this one. We'd love to see you again.